Keynote speaker is Professor Steven Schwarcz. He's the Stanley A. Star Distinguished Professor of Law and Business at Duke University and founding director of the Duke's Interdisciplinary Global Capital Market Center, now renamed the Global Financial Market Center. His areas of research and scholarship include insolvency and bankruptcy law, international finance, capital market, systemic risk, corporate governance, and commercial law. He holds a bachelor's degree in aerospace engineering and a doctorate from Columbia Law School. Prof, over to you.
Thank you so much, and good morning and good day to all of you. My topic is using financial technology, sometimes called FinTech, to expand financial inclusion. And I'll focus on what is called the fractionalization of securities. And this essentially means to take securities like debt securities, bonds, and equity securities like shares of stock and divide them into very small fractional interests that can be sold to investors. And I'll talk today about how this can expand financial inclusion in two ways. First, by enabling even small and medium-sized businesses, so-called SMEs, to more cost-effectively raise money. And second, to enable even lower-income individuals to invest in high-return capital market securities and also to diversify their investment portfolios. So again, fractionalization is the process by which individual securities can be divided into fractional interests, which can be sold to investors. Now, for perspective, please note that financial technology and fractionalization of securities is not completely new. But what is happening today represents another major step forward in development. Historically, securities have been fractionalized by the way they're issued. A share of a company's stock, for example, is a fractional ownership interest in that company. Financial technology, or FinTech, also has been around for many, many decades. The advent of computers in the 1950s and 60s made it feasible to transmit and settle payment orders electronically, to facilitate cross-border payments, to engage in high-frequency trading, and to develop complex and innovative financing approaches such as securitization. But today, FinTech also promises to enable fractional ownership in almost any type of assets. In a recent article, I focused on fractional ownership interests in what are called non-fungible tokens, or NFTs. And I emphasized the risks that these types of interests can raise. But what I'm talking about today is fractional interest in investment securities. And although these interests have risks, they're much less than the risks that are associated with selling NFTs. Let me discuss financial inclusion now. First, from the perspective of an issuer of securities, and then from the perspective of an investor in securities. And fractionalization, as I mentioned, can expand financial inclusion to issuers, most notably by increasing SME, again, small and medium-sized enterprises, by increasing SME inclusion. Now, the definition of an SME varies from country to country, but the term usually encompasses firms with fewer than 250 employees, although in some countries it defines it as fewer than 500 employees. And SME financing is critical. SMEs are responsible for the majority of the world's economic activity and employment. To give examples, in the United Kingdom, SMEs contribute over 50% of the GDP and over 60% of the employment. In the United States, SMEs contribute over 60% of the employment, similar to the United Kingdom. And if SMEs had greater access to financing, they could even further boost economic activity and jobs. Now, currently, SMEs cannot access capital market funding. The transaction costs of engaging in a securities offering, for example, issuing bonds to investors or issuing equity securities to investors, those transaction costs tend to be too high to economically justify the relatively small amount of financing that an SME needs to raise. And SMEs are therefore effectively relegated to borrowing money from banks. Now, there's nothing necessarily bad about that, but bank borrowing has two costs. Number one, it's more expensive than capital market funding. And the reason is that when you borrow from a bank, you are borrowing from an intermediary of funds. A bank itself will borrow money from the capital markets. They'll also borrow money from depositors, but a significant portion of their funding is from the capital markets. And so when a bank lends money to a company like an SME, the bank, in order to be profitable, must increase the interest rate. It's very similar to the old adage about how a company makes money. It buys products at a low cost and sells the products at a higher cost. And similarly, a bank borrows money at a relatively low cost, but then lends it to companies at a higher cost. And so, again, bank lending is expensive or more expensive than capital market funding. Secondly, banks will not always provide the amounts of financing that SMEs optimally will need. And furthermore, banks tend to limit their SME lending to only a small portion of the SMEs, those that have proven their creditworthiness. And in some cases, banks will not lend at all to an SME, even if it's creditworthy, because the amount that is being requested may be too small to justify the bank's transaction costs. Now, again, fractionalization can resolve this or help to resolve this by enabling SMEs to get more direct access and cheaper access to capital market funding. An OECD report observes that, and I'll quote, non-bank market-based financing can improve the flow of credit to SMEs while enhancing diversity and widening participation in the financial system. Now, SMEs could borrow in various ways. There are centralized ways to access the capital markets through so-called central bond exchanges. There are also increasingly so-called decentralized finance or DeFi alternative ways to borrow. And financial technology, again, can facilitate both of these ways by representing each fractional interest and its transfer using technology, primarily in this case, blockchain. And blockchain, you may have heard, this is an industry jargon which can cause confusion and essentially is where an asset is represented digitally and protected by a certain type of cryptography or computerized sort of puzzle protection. Um, I will talk about how this works in a few minutes, but essentially, blockchain in its most widely used form is a computerized database that records information. It acts as the electronic equivalent of a paper ledger. And to reduce the need for a trusted central intermediary, blockchain databases typically are stored in multiple computers. And when this happens, each computer in industry jargon is called a node, Node. And the trust is provided by a certain amount of cross checking redundancy among each of these node computers. And the idea is that the information in each node computer would have to be identical to that information in all of the other node computers. So, in order for a hacker to get in and change information, they would basically upset the redundancy, and that would number one be difficult to hack all the computers, and number two, if there are inconsistencies, that could be seen. Now, I just talked about from an issuer perspective how fintech can help to increase financial inclusion. It also can increase financial inclusion from an investor perspective, and this relates to the issuer perspective as well. But fractionalization can expand investor financial inclusion by giving virtually everyone access to investment securities. Currently, if you wanted to invest, let's say, in a capital market bond, most bond prices are anywhere from 25,000 minimum to 50,000 denomination minimum. And clearly, few retail or consumer investors can afford these prices. If you fractionalize a security, you can divide that bond into, for example, $100 increments or $500 or $1,000 increments. But the point is, much, much smaller increments. And this will increase vastly the number of investors who can invest in the capital markets. And that's good for two reasons. From an issuer inclusion reason, it means that capital market financing will increase in the aggregate, providing more money for issuers, more money for SMEs to borrow. Secondly, in many countries, a very small portion of the population currently invests. In France, for example, only 6% of the population engages in retail investing. In Mexico, it's only 1%. And shifting more financing from bank lending to the capital markets and thereby increasing retail investing are central goals of the European Union. The EU has been working for some time to implement a so-called Capital Markets Union, or CMU, to harmonize its various member countries' capital markets and make them more efficient. And a central focus of the CMU is to motivate retail investors to become alternative funding providers, especially for SMEs. Now, finally, I mentioned that fractionalization can create more risk. And in the case of non-fungible tokens, these risks are very high. Non-fungible tokens, or NFTs, are fractional interest in such assets as art, collectible cars, basketball video highlights, real estate, and even fractional interest in fictitious real estate used in video games. And they do not ordinarily generate cash flows. And an investor in NFTs, its only source of repayment is to sell the NFT to other investors who would want to buy NFTs. But the problem is, the risk is that those other investors, that other market to purchase NFTs may not exist. Where you have typical investment securities, in contrast, like bonds and equity securities, number one, it's more likely that a market for their purchase to resale will exist, although there is always the inherent risk that a bond or an equity security that has a robust market for resale will not have the same market for resale if you're selling only fractional interest in that security. But there is a so-called second way out for investors, especially in the case of fractional interest in bonds. Bonds will pay principal and interest on a regular basis. And so even if an investor is unable to resell its fractional interest in a bond, that investor will receive cash flow, a fractional interest in the principal and interest that is paid on that bond. An investor in a fractional interest in an equity security will have less protection. You don't have a regular expectation of principal and interest, but at least it will receive a fractional interest in any dividends paid on the bond. So fractional interest in bonds are marginally, if not more, safe than fractional interest in equity securities. And in terms of the current market development of the sale of fractional interest, it's somewhat anomalous that the parties are starting with fractional interest in equity securities and not in bonds. And that is hard to explain. Finally, regulation of these risks. Regulators should be able to regulate risks associated with sales of fractional interest in securities. And that's because most countries have a very well developed securities law. And a securities law that would cover the underlying bond or underlying equity security also should cover a fractional interest in those securities. Now, that does call into question as to how securities laws should operate. And there are issues when you sell fractional interest to consumers and less sophisticated and smaller investors, how the disclosure should operate so that the investors fully understand. There are also potential suitability requirements, so-called, should you be selling these interests to widows and orphans, as the line goes. Also, there's a question of consumer protection laws. Currently, the sale of securities does not have the protection of consumer laws. But if you're selling fractional interest, then you may well need consumer protection laws. Another issue is the tension between so-called anti-money laundering laws, or sometimes called AML, and privacy concerns. Worldwide, there is a lot of concern that when you sell securities or when you transfer currencies, some of those transfers may be used either for money laundering or even, for terrorist purposes. And there are worldwide various anti money laundering laws that include know your customer laws. So a bank, when it transfers money, should know the customer that it's transferring the money from which it's transferring the money, and ideally to whom it's transferring the money. If you apply that to a consumer basis, in the case of fractional interest in securities, that does basically take into account, or at least raises, privacy issues. And we need to worry about how we can balance these anti money laundering and anti terrorist financing goals with the goal of protecting privacy. And part of that issue is, should these transfers take place through an intermediary, like an exchange, or on a decentralized basis, what I refer to as DeFi basis, and that gets to be fairly complex, which I will not get into. But that essentially sets forth the ways in which financial technology can help to facilitate financial inclusion, both for issuers and for investors. And I would welcome any questions or comments.
Thank you very much, Prof. And thank you also for the sacrifice, because I know it's very early now at your end. Thank you for making out time to join us and to make your presentation. I have a couple of questions, but one first question I'm going to take is from the audience, and it says, what financial technology is structurally available for education in sustainable development?
What, if you could repeat that? I wasn't sure if you were asking
What
about
financial technology is structurally available for education in sustainable development?
Yeah, well, the education, of course, is what this conference is partly doing. I will say that there are other forms of education in terms of articles that are coming either out there or coming out. And the person who asked that, if they could email me, and I'm at Duke University Law School, the email's on the internet, or perhaps you can send it. I will be happy to send them a draft article on this topic that I am working on with a co-author, one of my research assistants, and that will lay out these issues in more detail, and also will give citations to sources which this audience member can read if he or she wishes to. And if other members of the audience want that, I'm happy to send it to however members of the audience are interested.
Thank you, Prof. I'm going to dive into one of the questions that I've shared with you before. And I'm going to ask, how do women take advantage of FinTech? Women are globally largest business owners, and they qualify under the SME bracket. How do we bridge the gap of technology knowledge and access to finance and to use FinTech as a tool for leveraging empowerment for women and bridging the gap for women business owners globally?
Right. Well, there's nothing about FinTech that I'm aware of that would differentiate between women and men in terms of the availability or the use. Um, so I think probably the more interesting question, or not interesting, but perhaps more relevant question at this point, would be how can people access this? How can people who are running SMEs access this? And this is very much still in process. But even now, there are firms like Robinhood that are getting into the business of selling fractional interest in securities, in particular in equity securities. At this point, until everything is sort of hashed out in a sense. This is still a technology in development. And as we've seen in the past day with the bankruptcy of FTX, some of the technologies in development, in that case, a cryptocurrency and other exchange, can create associated risks. But once the market becomes more robust, which I would expect in the next year or two or three, the risk will be better managed. I also understand that the established brokerage firm Schwab is now beginning to offer fractional interest. And that, of course, is perhaps certainly a more established intermediary to use. But in terms of how women can take more advantage of this, I wouldn't see that there's any difference between women and men. But if there's an example you could raise about that, I'd be happy to try to respond.
I was actually looking at that, framing that question from the perspective of women in developing and underdeveloped countries, where there's already a gap in terms of access to finance between male business owners and female business owners. So we need to bridge the gap in terms of education and access to ICT and helping them to be able to leverage on fintech.
Absolutely, and certainly, it's important for women to get the same education in these areas as men, and ideally, firms that provide these opportunities should provide them equally to women-run SMEs as to male-run SMEs.
Thank you very much, Prof. There's another question here. What are the challenges to be overcome by fintech, especially with inclusion?
Well, that's a very broad question, of course. What are the challenges to be overcome by fintech? And like any new technology, we see certain of the applications, but we don't necessarily see today all of the future applications. This is a question actually more broadly associated with scientific advances. Many scientific advances, when they occur, people do not see any applications or see very limited applications. And as the science becomes more familiar, the applications increase. So, I'm answering that general question in a very general way. If you can perhaps make that question more specific, I will try to answer it more specifically.
Thank you again. Thank you again for your presentation, Prof. I'll let you go on now to enjoy the rest of the early morning, your side.
Thank you. Thank you so much.
Thank you, Prof.